When you lock in a term on a mortgage, the bank is committing to you and you are committing to the bank. You both have a contractual obligation. In order to break that commitment, there is a penalty that needs to be paid on your part. Now, the banks offer different alternatives, such as portability if you're moving, or assumability if you're selling, portability being by far the most popular. But if you have to break, then there is a penalty that you have to pay. You would pay the higher of two different calculations. There is the interest rate differential. So if interest rates have declined and you break your mortgage, you could lock in at a better rate, and the bank is losing out on you paying at a higher rate. So it's the difference between the two rates times the principal times how much time you have remaining. The simpler of the two is 3 months interest. So it is just literally the percentage interest rate times the balance that you owe divided by 4, or if you prefer to think of it, times 3/12, which is the same thing as dividing by 4 in order to get 3 months interest. So let's look at an example. So let's say you have a $250,000 mortgage. You are locked in at 5%. You originally had 5 years on your term, and you've got 2.25 years remaining. So we look at new rates. On a 2-year term, a new rate is 2.5, on a 3-year, 2.75%, and on a 5-year, 3%. So first question is, which rate do we use? We take the rate that's closest to the existing term. So we have 2.25 years remaining. We round that down to 2 years, and we use 2.5% to calculate the interest rate differential. So let's do the interest rate differential. So again, interest rate differential, the difference between the two rates. So I'm paying 5% minus I would be paying 2.5% times the principal times the amount of time remaining, 2.25 years. So we calculate that, we get $14,000, 62.50 cents. So pretty hefty penalty. We're going to charge the higher of the two. So what would 3 months be? Just the principal times the rate times the divided by 4, or times 3/12. Get the same answer either way. And we calculate that, we get $3,125. So you see a pretty hefty difference. Which one would we charge? We would charge the $14,000 because that's the larger of the two. The IRD only gets charged when interest rates have declined since locking in. So people who are locking in right now, highly unlikely they'll ever pay an IRD on this term. Although in a future term, if interest rates have increased and declined again, that might be the case.